and thank you for joining QuotedData's Round the World webinar series. Today we're going to be focusing on one of the managers who is on our panel for our European section. Evert Castelein from Aberdeen is the lead fund manager for Aberdeen European Logistics Income PLC, and he's with us today to discuss the company and how it is managed by the team at Aberdeen. I'll be handing over to Evert to run through the presentation with you.
Well, thank you for this introduction, and thanks for having me today. My name is Evert Castelein. I'm based in Amsterdam, the Netherlands, and I've been the lead fund manager of ASLI since we IPO'd in December 2017. We're listed on the London Stock Exchange with a strategy focusing on pan-European logistics. So one of the first things I would like to discuss with you is just a brief summary of what I have to say, the key takeaways of today's presentation. And first point to make is that if you look at the logistics market, it's really a story of growth. And you can probably relate to that on a personal basis. We've all started to consume much more online, especially during the lockdown that we have experienced in the last 2 years. And with the rise of e-commerce, the demand for logistics space has really accelerated, resulting in an undersupplied situation across the entire European market. Demand is really strong, supply limited, and that means we are looking at increasing rents. So this is really a story of growth. In terms of the focus that we have with this strategy, we're focusing on the continent, not so much the UK, for a couple of reasons. I think first of all, the UK was already quite mature at the time when we launched this product, and we felt that the opportunity really sits on the continent, which is slightly behind the curve in terms of e-commerce penetration, but it's also benefiting from full CPI indexation of leases. Very important, I think, in today's market, and it's also benefiting from the fact that German banks are really active over here, resulting in very attractive financing costs. The growth that I'm describing is also what I recognize in our portfolio over the year 2021, and also quite recently in January, we were able to have 3 capital raises which were heavily oversubscribed. We've raised 182 million GBP, which allowed us to buy 10 warehouses, and with 2 projects still in due diligence, I think we're looking at a very well diversified portfolio in which Amazon is at the moment the largest tenant. In terms of our focus, we're focusing on mid-sized big boxes and urban logistics. And the reason why we have selected this approach is because we think this is the most liquid part of the logistic market where we think growth will be strongest, because this is the part of the market where we see a lot of leasing transactions taking place. And that is so important because we want to have assets in a portfolio that have a second life. So in case a tenant leaves, we want to have a quick solution and find a replacing tenant. That's harder when you're focusing on ultra big boxes, sometimes with sizes of above 1 million square feet, where not a lot of companies can take that space. So liquidity is the magic word here, and urban logistics, where we now have built 53% of our portfolio exposure. And the reason for focusing on urban logistics is because we think this is the part of the market where parcel delivery specialists are looking for space. They're trying to reduce delivery times and at the same time trying to reduce transportation costs. And in order to reduce delivery times, the best way of achieving that is by moving in urban environments where there's a lot of competition for land already from other land users, which we have seen in London, for example, where rental growth has been extremely strong for last mile delivery hubs. And we think the same is happening as we speak on the continent, as said, which is slightly behind the growth curve with e-commerce penetration. So this explains the strategic focus that we have. And if we look at the performance held up really, really well. It almost feels like there is no COVID for logistics because of these structural tailwinds. We've had a double-digit return, 17.5% NAV total return up to Q3. and we've had a 13.1 shareholder total return performance for the full calendar year of 21. So really strong performance, far above targets, and this allowed us, in combination with the strong rent collection, to pay out the full dividend of 5.64 cents per ordinary share, which equals 4.84 pence in sterling terms. Strong performance and a high quality portfolio that is future fit. And with our strategy, we try to keep our portfolio in a good place, because we recognize in the market an increased ESG awareness. Companies prefer buildings with strong ESG credentials, with solar panels, with insulation, with LED lighting, for example. And yeah, I'm very pleased to say that we were able to become sector leader in the GRESB survey. GRESB is the global real estate sustainability benchmark, leading indicator worldwide to measure your green performance. And within the category of listed trust with a focus on logistics, we're best in class. We're installing solar panels, as I mentioned. We're working on a net zero carbon strategy. So we're ready for the future, and I think well positioned also to benefit from the growth that we are expecting to happen in the market. So that is in a nutshell what I have to say today. If we zoom in a little bit on the other agenda points, to start off with the market overview on slide 4 is where you can see the map of Europe. Next slide, please. If you want to be successful in logistics, then it's really simple. You need to follow companies and where they want to be. And logistics is really a cross-border and international play. And a really good indicator is what you can see on this map is the amount of leasing transactions that have taken place. In this particular situation, we've selected 2020. But you will immediately see where the gravity point in Europe sits. So most active markets have been the UK, the Benelux, Germany, and Poland. And in absolute terms, over the last 10 years, Germany was even the most active market. And the reason for that is because of, first of all, it's the largest economy in Europe, but also the dominance of the manufacturing industry. Second largest is the UK for the same reasons. Third largest is Poland. Poland is benefiting from low labor costs and a dominant manufacturing industry. And on the fourth place is the Netherlands, which is benefiting from the largest seaport in Europe, which is the port of Rotterdam. So what is really important is infrastructure, transport corridors, for example, seaports leading from these hubs towards large population concentrations, and the presence of industries such as the manufacturing industry that uses a lot of logistics space. So if you understand these drivers behind logistics, then you understand where companies want to be and where you want to be as an investor, and where you can find assets that have a second life because demand is so strong. So that's the sort of European context that I would like to give. If we look at the demand drivers, I already mentioned the impact of e-commerce on the logistic market. This is by far the strongest driver behind increased demand for logistics space. The retail market is moving online, and for online retail, you need 3 times more logistics space than for standard retail in a high street. And that can be explained, for example, if you look at the sort of dense network of logistics required to run such a business model. So you need to have an e-fulfillment center where your parcels are put together. You need to have a reverse logistics center where parcels that are sent back are checked on quality and repackaged. And you need to have the last touch in the supply chain, the so-called last mile delivery hubs. So the market's expanding, and according to Prologis, every billion spent online requires 1 million square feet extra logistics space. So e-commerce plays a very important role, but due to COVID, we've also seen a trend of companies building inventory levels and the nearshoring trend of manufacturers moving back from Asia back to Europe, all to make supply chains more resilient to external shocks. And so these three trends make the demand side of the logistics market really, really healthy. Are there differences across Europe in terms of online penetration? Yes, there are. I think the UK can be seen as an early adapter in that respect. Almost 1/3 of retail sales are taking place online, but the rest of Europe is following in your slipstream, and we expect that in the next 5 years that this trend will accelerate. Also, thanks to the impact of COVID and the lockdown, a lot of people and also new age cohorts have got used to use the internet to buy products online. And this is a very strong driver, as mentioned before. What does this mean for the supply-demand balance? Well, there's an undersupplied situation across the entire European market. As shown in the chart on the left-hand side, supply can't keep up with demand. Highlighted in the blue chart or bar chart, the net completions, so the development of new logistics, and in purple, the net take-up of logistics space, which is much higher, meaning that as a result, the vacancy rate has come down from 9% in the year 2009 to a current 4% almost, which is really low. And in some pockets of the market, there is simply no stock available, especially in urban environments in the largest cities in Europe. So with this strong demand, lack of supply, what does this mean for rents? Well, rents have gone up already for quite some time. And this trend is even further supported by rising construction costs. So costs for raw materials, timber, iron, scarce land and labor has gone up and has resulted into a situation where construction costs has almost doubled. Sorry. So the only way for a developer to make a profitable product is by increasing rents. So that explains part of the growth story. Another part of the growth story can be explained by the fact that many investors have put logistics on top of their wish list. I mean, yeah, we all know that the office sector has some challenges with people getting used to work from home. We all know that the retail market is struggling because it's moving online. But for logistics, I mean, the drivers are really structural and not cyclical, explaining the increased appetite for logistics, which was around 15 billion some 10 years ago to its current 50 billion. So that's almost, that's more than 3 times the total investment volume right now. So yeah, the market is hot. That's also reflected in yield compression. So yields have come down, especially for core assets that are well located and assets with modern specifications. But it's still providing a decent premium over the risk-free rate, although that has clearly narrowed a little bit in the last couple of weeks, what has happened with interest rate hikes. But I think it's still a strong story because it's a growth story. So the yield only tells part of the story, of course, and we think that in combination with indexation of rents and the rental growth that we are expecting, that logistics will remain one of the preferred sectors by many investors looking for yield. For those of you that have some experience with logistics and maybe in the UK, let me just point out a couple of differences and try to convince you, of course, that the European continent also has some key attractions. First point to make here is that the e-commerce penetration on the continent is slightly behind what we are seeing in the UK. But countries such as the Netherlands, Poland, Spain, and Italy are really following your slipstream with high growth expectations for the next 5 years. For example, in the Netherlands, Amazon has recently opened its first warehouse, and we all know what happens when Amazon is entering the market. They're a disruptor, and companies need to follow in their slipstream, because otherwise they're going to be squeezed out of the market. So we think a lot of growth still needs to happen on the continent, where it's easier to diversify your risk. I mean, 75% of the total investable market in Europe is outside of the UK. And on the continent, you're also benefiting from full CPI linkage against the UK, where normally rents remain flat until after 5 years, where you enter into a market rental review. On the continent, we also have that, but on top of that, you have the annual increase with CPI. And German banks are really active over here, and that also means that financing costs are lower. For our portfolio at the moment, the all-in cost for a loan portfolio that has a 7.25 average duration at time of signing the loan agreement, that is quite attractive, of course, 1.4%. And Aberdeen as a house, I think, and that's a really, really important point to make, is, and that is really one of our unique selling points, is the fact that we have local resources. So we're the second largest real estate investor in Europe. We have 8 offices, local offices across different European countries. And that means I have, as a fund manager sitting in the Netherlands and Amsterdam, access to on and off market deals in all the countries where I want to be invested. And that is really an important point to find the right quality stock at the right price. If we move on and focus on the portfolio overview, a few objectives and risk factors, which I think are more for further reading. If we zoom in on the portfolio, you can see on the in the map that we've bought quite a few assets in the Netherlands. The Netherlands is a very densely populated country. It has the highest logistic density in Europe, thanks to the seaport of Rotterdam. So I'm really happy with the 6 assets that we have bought over here. We also have bought 2 assets in the Frankfurt Rhein-Main region, in LNC and Fleursheim. We have 3 assets in Poland. Both countries, of course, have dominant manufacturing industries, and that's why we think logistics is performing really well in these countries. We have 2 assets in France, and we have increased our exposure in Spain quite significantly, which is now, after the purchase of the so-called Sky portfolio in Madrid, the country where we have the highest exposure. 53% is urban located. As mentioned in the outset, that's the part of the market where we think a rental growth will be much stronger than for the ultra big boxes, because of the focus of parcel delivery specialists. It's a high quality portfolio. 76% of the assets in the portfolio have been built in the last 3 or 4 years, meaning that they tick all the boxes in terms of modern requirements. A good example of that is the asset that we have bought in Lodz in Poland. Lodz is the 3rd largest city in Poland. It's very central located alongside the main transport corridors. And it has a direct connection to the Silk Road, the railway connection between Asia and Europe. And the reason why we bought this asset is, first of all, the very attractive yield, 5.64%, full CPI indexation as well. And our building, it's brand new multi-tenanted asset with number 1. Has a direct link to the companies on this location. It's called the Bosch Siemens Hub. So companies that are manufacturing dishwashers, washing machines, ovens, microwaves, they're assembled here. I believe every 30 seconds a dishwasher is produced here. So we think that the tenants that we have in our building that are subcontractors, for example, specialized in packaging materials, are very sticky because they have a direct link to these companies surrounding them. So, and a good example of the kind of assets that we are buying that are high yielding. We've also bought assets that are somewhat keener priced. For example, the one in Barcelona, a really good example of an urban logistic warehouse. As you can see on the map, in Barcelona, there's a supply constraint. At the east, you have the sea. At the west, you have the mountains and the forest. And this building is located in the middle of a residential area. And it's very difficult to replicate such a building in Barcelona because there's hardly any greenfield location available, which is also reflected in a very low vacancy rate. So this is an example of an asset where we have strong rent growth expectations. Even though there is still 5 years to the next break, we will notify this tenant before this break that we would like to grab some of this upside potential because the building is heavily under rented, we think by at least 20%, but probably more. So we're going to ask them to pay a higher rent. If they refuse, then they have to leave, and then we're going to replace them with another tenant such as DHL, UPS, or Amazon, the kind of companies that would like to lease these kind of smaller buildings close to residential areas. A final example, and really a milestone deal that we have closed in December, an example of urban logistics, is the portfolio called Sky. It's a portfolio located in Madrid. You can see on the picture the assets that we have bought. The assets have been developed in 4 phases. Phase 1, 2, and 3 have been completed, and phase 4 is currently under construction. It's a 227 million deal, 7 existing buildings, and 1, as mentioned, still under construction. And yeah, I mean, this is urban. This is Madrid. Madrid is, after London and Paris, the 3rd largest city in Europe. The location is superb. It's at 20 minutes driving distance from the city center, and explains why the largest tenant in this portfolio, Amazon, wants to be here, because within 30 minutes driving distance, you will find 6 million consumers. So very well located alongside the ring road of Madrid, alongside the north-south transport corridor. Modern specifications, brand new buildings, simply as good as it gets, and also explains for other tenants such as Carrefour, supermarket, Arrival, a producer of electrical vehicles, MCR, which is specialized in electronics. Amazon is the biggest client, and Talentum, a company specialized in marketing materials, wanted to be here. So this is the kind of product quality that you like to have in your portfolio, where we also have very strong growth expectations for the future in terms of rental growth. If we look at the overall portfolio since acquisition, a lot of detail on the assets in this table. What is important to mention here is that since acquisition, we have experienced a 19.7% total capital growth, which was mainly yield driven, although we've also experienced some rental growth. But as mentioned already a couple of times, we expect that more and more of the capital growth will come from rental growth, because the market is extremely tight. There's hardly any modern stock available, and I think with our portfolio, we're very well positioned to benefit from that growth. In terms of the kind of tenants that we have in portfolio, really important, of course, because these are the tenants that pay monthly rents, from which we can pay the quarterly dividend. So at the moment, our portfolio is almost fully occupied, 99%. We were able to collect 98% of rents due over the full year, which is really high. And the kind of companies that we work with have a focus on transport and logistics, of course. We have DHL in the portfolio, manufacturing, especially the ones that are based in Poland and in Germany. We have a large component of tenants that have a direct link to the food industry, supermarkets, Spio, Coop, Carrefour, or importer and exporter fruit and vegetables, Combilo in our Waddinxveen asset. Yeah, the food industry has performed really well in the last couple of years, and so we don't have any concerns there. With retail, which is just a smaller component of our tenant base, you need to be careful because some retailers have been struggling, of course, but the ones that we have are doing fine. Example is Decathlon, the discount sports retailer. They've had an excellent year. Or Kruidvat, which is a drugstore part of the Ace Watson group, and they're running the e-commerce platform from our building in Ede. So strong companies, just like Amazon, of course, making the 11% of our exposure to e-commerce. So that is our tenant base. If we move on and just focus on ESG, yeah, this is really something that we have put on top of our agenda. Of course, with ESG, always a lot of warm words, but we all know what's happening, and there is an increased ESG awareness, I think, in the overall market since the signing of the Paris Climate Agreement in 2015, with a focus on global warming and the impact from carbon emission. We're developing a net zero carbon strategy for our portfolio and our buildings. And yeah, a very easy way to reduce carbon emission, of course, is the example on the picture by putting solar panels to work. We now have 10 buildings with solar panels on the roof. Yeah, for tenants, this is really important because they can buy eco-friendly energy directly from the roof. So if you're using a lot of cold storage, then yeah, this is an important way also for these companies to work on carbon, and will increase the stickiness to the asset. And yeah, we're sector leader in GRESB. So as you can see on the in the results, the survey results, out of the group of 6 listed strategies with a focus on logistics, we're the #1. We were able to increase our rating in the last couple of years. And yeah, that tells me that we're on the right track, that we have a liquid portfolio that is future-proof, and we're trying to yeah, stay on the front foot on this topic, because it's not only the right thing to do and support for us, but it's also important for our investors and for the tenants that we work with. If we focus on the financial highlights, I think I already mentioned the key points in the introduction. Double-digit returns, strong performing portfolio with low risk on the financing. We have a loan-to-value ratio target of 35%. So we're using gearing, but not too much. Of course, it's creating financial leverage with a 1.4% all-in cost on the existing loan portfolio, but we're taking a modest approach. We don't want to bring it above 40%, but in the long run, we would like to be around and close to 35%. In the pie chart, you can see the indexation clauses that we have, and that is really important, of course. As mentioned, indexation, inflation is really high, and on the continent you get full CPI linkage with annual corrections in the rent. 65% of our leases have full CPI indexation, or ILAT indexation, as it's called in France, which is even better because it's a blend between GDP growth, CPI, and construction cost indices. And construction cost indices have gone up quite significantly because of high cost for raw materials. We have 28% of leases with indexation clauses that have a cap at a quite high level of 3% or 2.5%, and we have threshold indexations in Germany. But with the average inflation of 5% in the Eurozone in 2021, we think that now that the indexation linkage will be triggered for the corrections that will take place this year, always looking 12 months back, we think that the rents will go up as a consequence. So yeah, in summary, I think we're in a really good position today. We've built a very high quality portfolio with a lot of brand new assets. We're focusing on urban logistics, mid-sized big boxes, which we think is the most liquid part of the market, where growth expectations, especially on rents, are highest. We're benefiting from full CPI linkage for the majority of our leases. We've had a very strong year, double-digit returns, far above the target total return of 7.5%. And yeah, abrdn is one of the largest real estate investors in Europe. Scale does matter. I mean, it's a bit of a cliche, but the property business is a local business. You need to speak the local language and have a network to source on and off market opportunities, and that's how we work. And yeah, our portfolio is future fit. We're focusing on ESG, and we're building the portfolio with new assets. We have 2 projects in due diligence in France and the Netherlands. And yeah, we're looking forward to grow together with our investors like we've done in the last 4 years. Thank you for